Me this time? Okay. Well, well, we got a little feedback. Okay. Welcome to our February 13th Fire Pension Board meeting. We like to get things started. Do we need to do a roll call? I don't know if we don't typically do that. Okay, all right. Well, then we'll get right into the first order of business. As you know from our last discussion, we had a discussion about bringing on board a management side trustee, solicitor, to advise the management team. Everybody was in agreement, so we have, in the interim, issued an RFQ for qualifications. We ended up interviewing Mr. Jay Dorsch with Cozen O'Connor, and we recommended bringing him on board. We got Jay sitting here. Again, I think probably Jim, and I'll ask, uh, we should probably have a vote to just bring him on board as a solicitor, or is it just?
Yeah, just a motion to welcome.
Yes, okay. So with that, I'd ask for a motion to welcome Jay Dorsch on board as co-solicitor. Got the motion?
Second.
Got a second? All in favor?
Aye.
Aye. Anybody opposed? All right, very good. Welcome very much, Jay.
Thank you very much.
And Jay, just for the record, if you just share just a little bit about yourself. So I did send your credentials out to everybody, but for those folks who are watching who haven't seen that, just share a little bit about yourself.
Sure. First of all, thank you very much. I have to tell you, I don't think I've ever been voted unanimously by anything for anything. So that's, really appreciate that. I am chair of the Employee Benefits and Executive Compensation Practice at Cozen O'Connor. I've been practicing for over 40 years in the employee benefits, executive compensation space. I've had the opportunity to represent other municipal pension plans, and I look forward to working with the trustees as well as Jim Beal on this fund as well.
Thank you so much. First, next order of business is investment reports. Thank you, sir.
This is on, looks like. Okay, good morning, everybody. The WMS report that I put out is for the overall pension plan, asset allocation and performance, which we are responsible for reporting on and making sure that we're compliant with our investment policy statement. And then the second tab is the specific portion of the portfolio that we manage with a more sort of conservative mandate. So 2024 for the calendar year ended up being a really, second in a row, really positive year for equity performance. We had a very narrow lead though in the market. We talked about this when we were last together, that the majority of the index was driven by what is referred to as the Magnificent Seven. So stocks that are sort of based around the AI theme. Those 7 stocks have grown to be over 30% of, well, as of year's end, over 30% of the S&P 500, and the other 493 stocks made up the rest. Those periods of that kind of concentration don't end up necessarily boding well for the overall market because sort of the law of big numbers. It can't continue forever. We saw it with the tech bubble in the late 1990s, the nifty 50s in the 1970s. And so that really is what drove a lot of the equity performance. And obviously enthusiasm after the election too, certainly helped in terms of some of the pro-growth plans of the administration. However, one of the things that is a little bit more of an issue is interest rates have actually trended back up and have stayed up. And that's primarily because of inflation. Inflation has been particularly sticky. The Fed actually started to reduce interest rates this past year, but it looks like they may actually already be finished. I think there's a possibility of another cut by the end of the year, but that would probably be at most. We just had another reading yesterday that was stubbornly higher than what was expected. So that really is sort of our biggest concern. So again, at WMS, we have the more conservative mandate. So we therefore have a lot more of fixed income investments within the portfolio for the plan. And what we've done is we've stayed relatively short in terms of our interest rate duration. It's proven to be a very positive thing in terms of relative performance. Our intent is to stay there. We had with short-term rates starting to come down with the Fed, the plan was to start to extend our duration a little bit, but we did not do it. And fortunately, as things played out with rates, that ended up being a good thing. Then on the equity side of things, our exposure is much more broad in terms of relative to those Magnificent Seven stocks. We have a portfolio of equities that are internationally diversified, and then also more factor-based in terms of the composition of the strategy. So looking for quality, looking for size, for less volatility, and so that was a negative for the calendar year of 2024 in terms of relative performance. But I think we're really positioned well on a looking forward basis. And even in this short period of time so far this year in 2025, we've seen international stocks actually outperform US for the first time, and it's only been a month and a half, but for the first time in a really long while. And we're seeing more value-oriented and smaller stocks doing better at the expense of those Magnificent Seven stocks. So with all of that being said, let's dive into the allocation and performance. I'm under the first tab, page 2. This is for the combined portfolio value as of year's end of about $51.2 million. The asset allocation is in line with our investment policy statement, about 64% in equities and 34% in fixed income and cash. And so, between the two portfolios, staying, where we want to be in terms of our targets. For the calendar year, the overall portfolio was up almost 11.5% over the past 3 years. So remember, 2022 was a really rough year. 2022 was when the Fed started raising interest rates, and every traditional asset class, performed poorly. Stocks, bonds, you name it. Bonds literally had one of their worst years ever. So looking at 3 years back, that takes obviously into account 22, 23, and 24. 4.4% annualized return over that period of time. And then looking back 5 years, about 8.1% annualized. If you flip to the WMS portfolio, the second tab, page 2, we are in line with our allocation. And again, we typically will manage our allocation around what Mike and CBiz are doing, just to make sure that we're compliant with our overall allocation. Currently, we're about 45% in equities and about 55% in fixed assets and cash. For the year, we were up just under 9%, 3 years about 2.5% per year, and then 5 years about 6.1% per year. Any questions? Okay.
All right. Thank you so much.
Thank you all very much.
Appreciate it. Thank you, sir.
If you would just give me about 5 minutes to give Jay a real quick oversight of who we are and what we do. Jay, we've been fortunate enough to be in the municipal pension world since the early 90s, found a niche market. Over the years, we've gotten to be known as the all indexed, all market guys through Pennsylvania. So really got known as the Vanguard iShares Index Pension Alternative. So we use an all-market approach, concentrating on the asset allocation to take the least amount of risk. Over 20 years ago, we gave the charge of trying to take the least amount of risk to hit the assumed interest rate. We don't concentrate our efforts on security selection. We concentrate 95% of our time on taking the least risk to try to hit the assumed interest rate over time. We handle over 100 and some municipalities throughout the Commonwealth. I just saw Pete over at the city of Coatesville. Congratulations, Pete. So here, the biggest decision we made as a group was when the assumed interest rate was much higher. We worked with the actuary and your auditors to show the committee that the plan had to take on slightly more risk to have any chance of hitting the assumed interest rate over time. So the biggest decision we made as a group with this committee going back, Pete, since 2011, and with the combined help of WMS, was to allocate more towards equities than normal pension plans. What that's allowed us to do is, since inception, if you go to the right-hand side of the kit and you open up to the first report and go to page 12, and this is just, I'm just covering right now the position that we manage. And as Paul said, we manage the more aggressive. We were given the charge of being more aggressive. So our allocation is 75-25 in conjunction with Paul's to bring us to 65% equities, 35% fixed income. If you take a look at page 12, if you look since the start date, since we went with the all ETF Vanguard approach, the performance was up 8.25. When we first came in at that time, the assumed interest rate was much higher. It was like 8%. So we were showing that you had to be at least 65-35 to get anywhere near that. So that was the coolest decision we made as a group. And as you can see, if you look at since inception, our performance was up 8.23. But as Paul said, bond performance overall more than a decade was at 1.67. Stock performance was at 9.21. So that's the total benchmark of the total stock market, total bond market. So allocating an additional 5% to stocks was really the smartest thing that this pension committee has agreed to do. Then if you look at the column last year is actually 2023, because this is a year-end report, so it gets a little confusing. So the reason I have 2023 there is you had roughly 17.86%, again, with a more aggressive charge from our side. When you look at the total portfolio, it was up 14.85. That's going to be important in a minute, because if you look, year to date is actually 2024. You know, we were up roughly 12.83%, again, because of the more aggressive charge. Bond market was only up about 1%. Your bond portfolio was up 1.75. The total stock market was up 17.32. Your stock portfolio was up about 17%. We had a little drag on the stock portfolio, given what Paul said. One of the other things that our clients remember is, first, they own everything, and we're concentrating on taking the least amount of risk to get the highest return by maneuvering towards international. Well, we were less international in the last 2 years. So what we're doing is trying to take the least amount of risk to get the highest return. So what happened is, combined, your performance on the stock side was slightly lower because we were buying large cap value, international, mid cap, and small cap stocks cheap because large cap growth, seven stocks ran. What I always tell clients quarter to quarter is by rebalancing. So not only do our clients remember they own everything, the second thing is they're always investment shoppers. You're always buying on sale. Counterintuitive, we're doing the opposite of what retail investors do. When something goes down, they sell, they panic. What we're doing with this pension is we're always buying on sale. So in 2022, when large cap growth was the lowest asset class, we were buying it. Then 2023 and 2024 hit, we got rewarded dramatically in 2023. 2024, what happened is that was a drag on stock performance. Anybody want to guess what's winning large cap growth? Do you think it's down? It's the lowest asset. It's actually up. But as Paul said, we sold large cap growth at the end of the year, moved it down, and bought it cheap. And then large cap value, small cap, and mid cap have done well. The reason I'm saying that for Jay's behalf is eventually I tell the boards across the Commonwealth, eventually we're going to look smart, Jay. I just can't tell you when. So the approach, we take human nature out of it. We're constantly rebalancing. We're keeping the portfolio in check. So the cool thing is in 2024, the combined pension had 11.4. In 2023, it had 14.85. You squish those together, you get 26.25. The goal was to achieve 6.75 a year because that's the most important thing. That's the assumed interest rate. 6.75 multiplied by 2 is 13.5. So what's really cool is your valuation will be done in the second half of the year by Joe Duda. The target was 13.5. You had 26.25. Why is that so cool? Because this board has been so prudent to knock down from 8% now to 6.75. That's below the median average of municipal pension plans across the Commonwealth. So you want to get on you want to have a reason to get on a soapbox? This committee is it. You're at 6.75 on an assumed interest rate, right? You're going to have some pretty cool things to look at in the second half of the year when Joe Duda does the valuation. Now, the pension plan, like most of the Commonwealth, is using asset smoothing. So when you got hit in 2022, you don't feel the full brunt of the market going down. But you've had such a big impact on 2023 and 2024, that's going to help with funding. That also dictates your MMO for 26 and 27, as Mr. Jones knows more than anybody. He's shaking his head. That will have a positive impact as well. So the coolest meetings will be when we get together after the valuation, which is normally done in the second half of the year. The other thing, what we do every year, and really the most important thing that's done on the right-hand side and in the back, is our capital market assumptions. Now, a lot of the folks across the state are using our capital market assumptions for your GASP 67 and 68 report. So what happens every year is your auditors and your actuary are using our capital market assumptions and they're comparing them to what your assumed interest rate is. Why that's important, if you go out to bond or you're going out to loan, people want to know, what you're doing in the pension plan before they allow you to lend money. Well, if you go to page 4 and 5 and you open it up like this, I'm working on getting the font a little bit bigger, so I apologize. But if you look on page 4, halfway through the page, our expected return on your current 65-35 mix is 6.8. And you're using 6.75. So you're also one of the few out of 160 some municipalities that we do defined benefit plans on. This is one of the few times where I'm coming in and saying our capital market assumptions, what we expect to earn in the pension plan is what you're using in an assumed interest rate. That's pretty cool. That to us, that's awesome. That's the goal. And then get the funding level up, which once Joe does the valuation, we'll be sharing that news. So this is really the most important part. You know, how do we target the assumed interest rate that you're using? Last thing is on the left-hand side, every year in the municipal pension world, well, two last things. In the municipal pension world, it's really just in Pennsylvania, it's really just the prudent man rule. It's kind of vague. You know, you want to do what the prudent man rule, you know, says you should do as a trustee. In the ERISA world, you can slide the liability for the investments to a 338 advisor as long as you do the due diligence on that advisor, right? So what we do every year, we were one of the first to ever go through Dalbar's 338 certification. So independently, and that's on the left-hand side of your report, independently, I look at this as our ISO. Dalbar takes a look at our insurance coverage, our performance, our years and our fees, and then they certify for our clients that they believe we are a credible 338. That's even more important. The reason we get it when 99% of our clients are municipal clients is because we think it's even more important in the municipal world because it's just the prudent man rule. And in the ERISA world, you would have been punting the responsibility to us. That's why this is so important. So when you get a chance, but really the first page says it all. We have evaluated qualifications, capabilities, and services of CBIZ Investment Advisory Services and determined that they meet all the requirements of ERISA 1974, Section 338, which permits an investment managers to be appointed as fiduciaries and manage the assets of ERISA plans. So without going all through it, when you get a chance, I would go through that in the essence of time. I'll leave it there. The last thing I want to bring up is probably the biggest thing that Paul and I are getting asked in these pension quarterly meetings is when is the market going to correct? I guarantee one thing, the only thing compliance allows me to guarantee is the market's going to correct. That I could say. I guarantee it's going to correct. We do not know when. And I've never had more conviction around our process than I do now, because quite frankly, nobody knows what's going to happen over the next 6 and 12 months. When we own everything, we're going to take advantage of whatever drops, whether it's on the bond side or the equity side. So given the fact that we believe there's going to be a correction, there's a slide on the left-hand side that looks like this. On average, the stock market drops 14% almost every single year. It's on the left-hand side of the kit, guys. And if you look, this is the positive years. So we have almost 33 out of the last 44 years were positive years. However, almost every single year, the market drops by 14% at some point in the year. That's actually helped our clients more because what we're doing is we're using bonds to buy stocks at a severe discount, right? That's normally what happens almost every year. So if you ask me when do I think there's going to be a correction, I think it's coming some point in 2025. What we're going to do is we're going to take advantage of it. We're going to buy stocks on sale, and that's going to help us in the long run. We will look smart. I just can't tell you when. The other thing that we expect is we expect more volatility and an uncertainty than we ever. This is my 34th year doing this. I've never seen this amount of volatility, and I've never had this amount of conviction in what we do because, quite frankly, we have no idea what's going to happen 6 to 12 months. What I can tell you is we're going to buy on sale, whatever that is. And it's always worked, and we're not guessing. We're taking the human aspect out of it. So this meeting towards the second half of the year is going to be, well, I think it's going to be really cool. You're going to have some nice things to take a look at as a whole. Any questions on where we are?
Thanks, Mike. I just want to make a statement and tell me if I'm interpreting what you said incorrectly. When you say interest rate, you're talking about the rate that's used in the calculation of our future liability. We'll call that a discount rate. It's not the interest rate that's being earned in the portfolio. The portfolio return at 6.8 on your Morningstar report is what we consider our total return on average over a year. That's our target in the portfolio. When you say interest rate, that's a different number that is being used to calculate our pension liability.
That's correct. So they're two separate, but the goals are the same. So that's a great question because that's 90% of the test grade. So the interest rate I was talking about was what Joe Duda is using when he takes the cost of benefits and then he's got to use a number that's expected to get in an investment return. And then he crunches it together and determines what the funding level is and what the MMO is going to be. That's the discount rate that you talked about, which is 6.75. What we've gotten since inception is actually over 8. However, if you squish the 65-35 together now, and you said, Mike, what do you expect to get? I would say 6.8. So when S&P or the banks, or you go out to loan, what they look at is they say, okay, give me the capital market assumptions from Gatsby that your advisor gave you, and then give me the assumed interest rate. The reason it's so cool that you've been on this committee for as long as you have is those numbers meet. It's not like the rest of the Commonwealth where they're using a 7% assumed interest rate and they're using a 50% allocation, and those numbers don't meet. That answer the question?
It does. Thank you very much. And then the second point regarding the risk that we're talking about here, when you said on a given year and you held up the chart that we have this, what was it, a 14% on your number, that on average, at some point in the year, every year the market corrects, and that's fine. And that's a very short-term look at volatility.
Yeah.
My bigger concern as a trustee is what this thing's going to do in a recession, a 2-year recession. All right. Because that's what's going to determine the funding levels required of the administration, that MMO, when that happens. And they've been through this many times before. So if we have a standard deviation of 11% on the portfolio, that means we could expect in any given year the portfolio to drop 11% on a very short-term correction, recovering and doing pretty much what our benchmark for that year is going to do. I think it's important to point out that in a recession, what we should expect from this number is a 2 standard deviation event, which would be about 22 to 25% drop in a recession, again, lasting through that recession. So we have the expectation not that when we get the recession, and you said you didn't say recession, you said correction, but I will say we are going to get a recession at some point also. We just don't know when. We should expect that kind of volatility.
You're reading my mail. Can I go to the next page?
Yep.
Because I got the actual number for you. So, and if I could borrow you for my next meeting at 2, that would be great. On page 5 of this report, remember I asked you to open up to page 5? If you take a look, that standard deviation that Dave just talked about, if you look over the 1-year period, this is showing you that there's a 95% probability when I come back here next year, we're going to be somewhere below 28%. And there's a 95% probability we're going to be somewhere above negative 9.91. And that does not take into account, what are we expecting to get? 6.8. That does not take into account what you call your black swan events, right?
Well, a recession is not a black swan event. The Great Recession was a black swan event, right?
Right.
This is normal economic cycle, the market reacting to that.
That's what this is.
Okay.
Yeah. It doesn't take into account, pandemic's not expected, but normal. So when you look over the 20-year, which is what we do, and when we're looking for Gatsby, the expectations are to be somewhere between 10 and 2, expecting still to get 6.8. So what I just did and what he just did for us is, as a committee, we're asking for now, and this might change after Joe does his valuation, because before he does the valuation, what you just asked, we're going to take a look and say, okay, well, what's the impact on the MMO if we drop 1/4 of a point, we stay the same? and the budget, the budget drives most of that. So you guys drive most of that consideration, right? So everything you just said is most important, and the second half of the year, Joe's gonna, sorry, I didn't want to steal your thunder, Joe, but what Joe's gonna do is he's gonna lay that out for you and say, this is what it'll look at. The cool thing is, you could make a determination to stay the same. You could say, hey, we'll drop it a quarter point or 50 basis points. But you're in a pretty good spot. Any additional questions? Thank you.
Second, all in favor?
Aye.
Anybody opposed?
Good morning, everyone. I don't have a specific report for today. We are working on the 1/125 valuation, which is what Mike alluded to earlier. So we will come back with results based on asset smoothing, which we implemented in the 1/123 valuation. We'll also take a look at going back to market value, depending upon whether the market value is going to be higher than the asset smoothing figure. And we're also going to look at possibly lowering the interest rates. We just talked about that, down to 6.5 and 6.25, just to see what your MMO would look like for your consideration. And that's it. So we're working on the val, and that's all I have for today. We should probably schedule a meeting in between the February and October meeting to go over the valuation results. So, yeah, because obviously you want to look at this valuation before you do your MMO calculation. So we should definitely do that. Okay, thanks.
Yeah, sit tight, Joe. That's later on the agenda to schedule a couple of extra meetings. And I have a favor to ask of you, and also one of you, Crandall. Joe, if you could circulate the most recent, the 1/1/2023 valuation. If you could
Okay.
circulate that again electronically.
Okay,
But,
sure.
that would be helpful. I'm going to take advantage of Jay being new to the team to get a copy of that on my system as well.
Okay.
And then Crandall, if we could get the most recent audited financial statement for the plan, probably 2023. 2023. If you could circulate that as well, that would be great. And then keep your calendar open. We'll see if we can get some extra dates
Yeah.
before everybody leaves.
I would think probably around August, September, because your MMO is in September. So this way I could have all these calculations for you to look at.
So what we've been discussing, it's just going to.
Okay. All right, thank you.
Oh, yes, yes.
No, I'm nothing new to report. I don't. For some clients, I've been giving a preview of what I think the new administration will mean in terms of legal issues, but that's mostly in the healthcare side. So I'll keep that report to myself unless anybody wants to catch me after the meeting. And I'll just be ready with my calendar for you all to set some dates, extra dates. That's all I have.
Next item was discussion of schedule. Process. So, next quarter. Somewhere between April and June. Yes. 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 So what we, if we want to do it now, we can put together, calendar, old calendar. But, yeah, we can do that and set up some dates for the next week. Same time. Very good. Next, any old business? Yeah, just one thing. I know in the discussion, we had discussion. So, this brings JR to skip. Yeah.
It's just fine. I think, just so there are no surprises, I think our retainers provide that, special projects are billed hourly. And so, and I would expect that there'd be some hourly billing for the developing and then administering the RFP process. But I do have some good news as well, which is, I think our timing may be good in terms of looking for a third-party administrator. They're, it's all timing right now because a lot of clients that have needed a TPA have run into trouble because there's been a consolidation and candidates have not been willing to submit bids. Again, so that there are no surprises, a lot of the candidates may be from definitely out of this region and likely even out of state. So, but that's not the end of the world. The main thing we want is the expertise to deal with the day-to-day of a plan like yours.
Anybody in favor of not, in favor of staying here or adjourning? All right, we stand adjourned. Thank you so much. Appreciate it.